Imagine a trading strategy that prints massive returns for 12 straight months. Then the calendar turns, and the exact same algorithm bleeds capital every day. The trader hasn't lost their skill. Instead, the underlying financial ecosystem, what quantitative traders call the market regime, has shifted. This graph illustrates the binary market states: high volatility macro expansions, where prices trend aggressively, or low volatility sideways compression. Traders destroy accounts by forcing rigid strategies into the wrong environments. Yesterday's logic clashes with the market's new state. Recognizing these regime shifts is the first step in long-term trading. Without that awareness, a proven strategy becomes a financial death trap. One major camp in quantitative finance is trend following. This strategy is engineered to ride sustained directional momentum. Trend followers look for movements triggered by buildings like this. Long-term central bank policies and persistent macro narratives create the momentum these traders need. The risk profile is specific. Trend followers must endure long periods of small, frequent losses while they wait to capture rare, outsized gains. This chart shows the strategy's fatal flaw. Notice how the blue price line erratically intertwines with the red moving average. When the macro trend ends and the market moves sideways, the strategy generates false signals and gets chopped to pieces. The opposite approach is mean reversion. This strategy bets that prices will constantly snap back to a fair value average. Mean reversion thrives in sideways consolidation. In the bottom panel, the strategy captures small payouts bouncing between these boundaries. But if the market breaks out, the logic collapses. Violent drawdowns wipe out weeks of profits as indicators fail to predict the price break. These two approaches are perfect mirrors. Each one is vulnerable to the exact environment where the other thrives. Curious, if mean reversion offers such a high win rate, why not simply trade it with more capital? Growing accounts eventually hit an invisible ceiling called scaling friction. These are the mechanical limits of market liquidity. Fading a price move requires pinpoint precision. As position sizes grow, they hit liquidity gaps. Your orders suffer massive slippage, struggling to find a fill against the market's momentum. Trend following scales differently. Because its orders align with the massive unidirectional flow of institutional money, it can absorb more capital without fighting the market. Market mechanics cap a trader's growth unless they implement strategies capable of absorbing immense capital without execution friction. Institutional quant desks solve this by physically stacking both opposing strategies into a single portfolio. In calm conditions, mean reversion generates steady cash flow. Simultaneously, trend following acts as insurance, absorbing sideways losses but capturing massive upside during sudden regime breaks. Combining these behaviors neutralizes their flaws, solving scaling friction and protecting the account. Long-term survival relies on building a robust, regime-agnostic system rather than endlessly searching for a flawless predictive indicator.